Does the sound all right? Okay. Well, I think it is a natural follow-on. I want to thank you all for coming and listening, and I'm looking forward to talking to you about this next presentation, because what we heard previously is correct. The drive for speed is frequently the root cause of what's destroying value in these projects. And you made a point about saying some of these executives, they might not quite appreciate the damage that it does. And I think that's true. I think no one's trying to destroy capital, but I think we have to give them data to show that the FAST project is not free. If you tell someone, I can accelerate this project for you a year ahead of schedule or a half a year, and they don't realize it costs anything, everyone's going to say, please do it. So what I'd like to do is give you some data that shows that it's not free. I'm neither Peter Kirkham nor Tom Mead, but they're the ones who did the research at our conference last November, so I want to give them credit for that presentation. And this is a highlight from that, a bit of a shorter version of that talk. True economic impact of project decisions. Long words, but it's really focused on how are decisions made early damaging the economics of some projects. So there's a quote up there, and you'll see many of these in press, about speed is of the essence. I'll let you read the quote, but it's really what we all hear is that the wisdom of getting there faster is accepted by almost anybody in the press, in reports, in press releases, in capital markets trying to raise fund for some smaller oil companies. The wisdom that fast project schedules deliver better returns is accepted almost without question by executives everywhere. But is it true? It's a leading question. That's kind of where we're trying to go through this presentation. So before, I want to have one slide on housekeeping. We've introduced a metric here to help make our case, and it's called a change or delta NPV. Most companies, as we heard before, we collect a lot of data on projects, but one thing they're quite guarded about is their NPV calculations, their NPV information. But what we can get is a change in NPV. It's a little bit less secretive to get that out. And what we are doing in here is simulating, calculating those changes in NPV for projects given their cost, which we know, given their cost growth, their schedule, which we know, their schedule slip, and given their production profiles, which we also know. So we're really just taking the actual NPV, subtracting the expected NPV at sanction, what was promised, and dividing it by the facilities and development well CapEx. It's really meant to give some kind of an equalizing measure that we can use in this presentation. And let's talk about aggressive schedules as well. We're going to hear about that. We heard that before. On the left, you see projects that we call not aggressive. On the right, aggressive. And for want of some kind of criteria, we called anything where the schedule that was planned was at least 15% faster than the industry benchmark would be as aggressive. 5–10% faster, no. But once you get to a 0.85 relative to industry of 1.0, we called it aggressive. And here's our calculator. That's the economic gain or loss as a percent of CapEx. And you see the mean for almost everyone in industry is actually in the red, not delivering what was promised. There are projects that have increases, but there's a statistical difference between those that are aggressive and those that are not. And the standard deviation, the variance around it, grows. It becomes much more of a crapshoot, if you will, once you have an aggressive schedule in what you're going to get. And here is the population of our study data set when we apply this economic gain-loss distribution. And as you can tell, it doesn't look very pretty in terms of what am I going to get. How believable are those sanctioned promises in terms of schedule, cost, or production? Now, like you heard, many of these projects, when they start to produce, obviously they're going to give revenue. But our industry is not very good at doing postmortems and looking back against what the sanctioned promises were. Many cases, increased oil prices or some other favorable, or just end up making some of these projects look quite revenue beneficial from a revenue point of view. But if you look at this, almost 2/3 of them, if you will, actually destroyed value. And many of these are actually NPV negative. They're producing revenue, but they were NPV negative. Company would have been better off leaving the money in the bank than doing that project. So just it's not a pretty picture in terms of How reliable are these forecasts? So I'm going to talk to you about the case for improved decision making. I'm going to share a little bit about the economic folly of schedule aggression, which I guess is a theme this morning, and then just some conclusions and a path forward. So we all understand that there are interrelationships and there are trade-offs. You can be cost-driven, and projects that are cost-driven, very capital sensitive, maybe in a lower oil and price environment, might end up not paying the consequence till things are up and running and we cut corners. Contractors might have cut corners, and you might see some operability issues. Quality-driven, some people say, look, we're willing to pay a premium, but we want a quality product, but often that means we have very expensive projects or with slow schedules and expensive projects. But schedule-driven, focus is on schedule, and here we see cost growth, we see poor production as corners are cut to meet the startup date. And that's just kind of the big categories or profiles of projects we observe. And how common is this? How common is the drive for schedule? We'll get to in a moment. But we heard that when we run economic models, it makes sense to everyone that what produces the revenue is initial production. That should be the most leveraging, and it is. Most people accept that. RPE volatility, that's actually change in your P50 or 2P reserve number. Reserves is kind of an SEC charged term, so we call it reservoir production estimate to get away from that. But it's really the 2P value that you justified the project on. Next most leveraging. Then cost growth. The more the CapEx grows, the more it's going to harm your NPV. The least leveraging factor is schedule. So how often do you think schedule is the driver in projects? 60% of the time. When we talk to project teams at Sanction, the primary driver is schedule in 60% of the projects we look at. About 20% cost and about 30% something else, maybe strategic or other interests. You'll note they don't add up to 100. That's because there's some groups of projects where it's not even clear what their main driver is, and they'll have several things as their main driver, which is a terrible predicament to put a project team into. And business is usually the reason that that happens, because they're not clear about what they want. It's very difficult for a project team to deliver when it's not clear what their primary focus is. So let's just go with the perception of value in a very simple NPV calculation. You see there in orange or yellow, the investment before sanction, before financial investment, FID. Then you see CapEx, you see a lot of negative cash flow there in terms of the red, and you see revenue over time. Ordinary schedule, let's call this an industry average schedule. And that would give you a baseline NPV. Now, we often hear people say, I think we can accelerate things. You're going to hear that in execution, you can't really accelerate things. It just takes this much time, a set amount of time to spend a certain amount of capital and get work done. So where can you compress your schedule? You can compress it where you control it, which is before sanction. So what we see is we might have birth of a fast-track project, and we accelerate. Let's take a year out of the front-end part. We assume we have the same capital outflow. We assume that we have the same revenue stream. And you see that you indeed get a perceived NPV gain. This is what I mean. When you show this calculation to an executive, he's going to say, of course I want the gain. But the next part that we're going to talk about is what I think doesn't happen. The transparency of the implicit risk in doing this isn't communicated. We've anonymized a project, one of many projects that look like this, but we've anonymized it to use in this NPV calculator to make our point. We've called it the Rapide project. It's an oil field development. It was a fast-track offshore development. You see that its CapEx at sanction was around 2.5 billion. Wells, that was facilities, wells 1 billion. It planned a 30-month execution schedule, drilling schedule 1,000 days, 250 million barrel reserves, planned production plateau 100,000 barrels per day. Just to give you a look at the benchmarks, the cost for the facilities was not far from industry average, 5% above. Drilling as well, but the schedule you clearly see it's schedule driven. It's 20% faster than industry delivery. And they're assuming they're going to get that, recover that reserve base, and they're going to assume they're going to reach plateau without any hiccups. Now I want to walk back to kind of a flow chart about how we look and assess projects. We have a timeline called the pathway to success. And we have these antecedents and following points. On the right, you'll see the outcomes, right? Facilities cost, production performance, wells cost, and schedule. And you see a whole bunch of drivers that we statistically link with one or more of these outcomes. For example, appraisal is going to make a difference. The amount of data you gather, as we just heard in the previous talk, drives what your understanding of the reservoir. And that comes to what we call reservoir FEL, or reservoir definition. That's basically your business case, is that reservoir definition, that understanding. And then we might have this circle is actually related to teams, getting the right people on board. You have a good basis of understanding, you define your facility scope and execute a project. But decisions we make early on affect everything down the road. If we have little understanding of the reservoir, you will eventually get a better understanding, as we saw before, as you get actual production data or later wells. That's going to drive changes. It's hardly ever what you assumed it was in those cases. And who has to absorb those changes? The facilities and the wells, right? In some cases, the facility's already installed, so it's actually the wells group that has to absorb almost all of the changes to what takes place. And that drives cost growth in everyone's scope and schedule slip and production, and that's where the NPV is coming from. So we're trying to make this link, as you did, with calculations between the results in a business sense and what was understood in the reservoir. And here's an example. When we look at projects, we have what's called an appraisal effectiveness index. It looks to see how much static dynamic data you have, what kind of log, what kind of core, what kind of seismic data. And projects with what we call a conservative, good level of data are able to achieve, on average, a good level of definition. Doesn't necessarily translate into it's a mediocre facilities and wells definition, because this is probably the most value-added data, and it's average. When, however, we push the boundaries and shorten the appraisal cycle, these are the averages associated. It falls to an aggressive level of appraisal. That constrains how well you can define the reservoir. You can't, without the data, you can't do much more with that data. And it's associated with poor facilities and poor wells FEL. And now you're going to see the premise where we're going to make our changed calculation. So that project we had what we call borderline moderate aggressive. They had unrepresentative small amounts of samples and no dynamic data, but they had some static data in small parts of the field. That constrained their reservoir to average the worst level of definition. They had cost targets, industry average, a schedule target. We're highlighting red because with little information, pursuing an aggressive target is not really realistic. It's not matching up. They had reasonable wells targets. We saw a beautifully controlled facilities estimate, a slight underrun, negligible slip. They achieved the fast schedule, that's what they were supposed to do, and industry average outcomes, but who had to absorb all the costs? The wells. They grew 100%, slipped 100%, and PDA's production attainment. They're producing at 65% of what they ran their economics on, what they said they would, a year after startup. The reserves were downgraded 20%. Now, what do we know? We hear people say, okay, it's producing a bit below, but we'll make that up later on. But when we look at the out years in our data, they actually disappoint in year 2, in year 3, in year 4, in year 5. And we're left looking for other opportunities to tie into that top sites. So here's when we run it. The initial look was a project with a $1.991 billion NPV. Looks great. And we accelerated the front end, which, let's see if I can get this to click some more. There we go. Raises it to 2.1. See, this is where you show the executive this option. Why wouldn't he take this option? Of course, make it happen. You're engineers. We're optimistic by nature as engineers. We think we will solve the problem. We have confidence we will. And eventually they do. But we're going to see that capital gets destroyed with this push for schedule. But we had a slight underrun in the cost. That makes it look even better, 2.145. We ended up, so let's put some results in there. So they underran costs and they barely slipped schedule. Just looking at that, it looks better. But we were only producing 65% of what we promised. So now we're at half of what we thought it was. And we've downgraded reserves. And we had wells growth in cost. I'm sorry, it's just, come on. There we go. It's $381 million NPV. Would you still have sanctioned this massive, complicated project? Or are there some other opportunities that looked a little less interesting, less exciting, that might have been more robust use of your capital? So the point we're trying to make is, no one goes into that trying to destroy that amount of capital, but that's a lot of value that just disappeared because we thought that year of acceleration was free. So we have a common problem. When one or more of the targets is set so aggressively that the project is likely to be a major disappointment. One of the recs we talked about. Quality sacrifice for schedule, cost sacrifice, quality sacrifice for cost. A variety of trade-offs get made. Let's talk about the aggression. I just put together some of the practices to close up the talk with. Roughly half of E&P projects are schedule-driven. We actually saw in this research sample 60%. And this focus is established very early in the planning cycle, very early, and it kind of hangs as a shadow over everything the project does. The emphasis on schedule limits definition. That makes sense. If there's only 2/3 of the time to define the project, it's going to constrain your definition. And we tried to make a point with that flow chart that there's a cascading influence of that compromised definition. The problem is failing to recognize the magnitude of that effect. Project framing does not properly account for the trade-offs between cost, schedule, and operability. It couldn't, or we wouldn't sanction these projects, and leads to suboptimal NPV outcomes. So the issue here is, from an academic perspective, and sometimes IPA can sound academic in saying you should spend the time and get to a best practical level of definition. We recognize it's not always possible, but if you're not going to do that, you have to be much more transparent and honest about what the cost is of not doing that. And that's what we're not seeing. So if you want to go to the ABCs, antecedent, behavior, consequence, we actually would identify the schedule drive as the root cause of almost all of these issues. It compresses your definition, means you have less subsurface information. We heard how damaging that is. Parallel subsurface project planning, you're overlapping reservoir and facilities planning, so there's a lot more recycle and rework as new data comes in. Poor planning for the execution of the project, and we get unrealistic estimates. And the consequence is production shortfall, downgrades, cost growth, significant destruction of planned NPV. Here's a visual to show what happens, yeah? Idealistically, you would have some kind of a sequential process. This does minimize changes to your project when it's done sequentially like this. We think it's unrealistic, but these projects do still happen, and they have among the better results in the database. But we get pressure, so we have some kind of overlap or phasing of it, and we get further pressure, and we get a full overlap of those early phases. And that gets you to an early startup, but that means you can't be surprised when you're absorbing a lot of expensive late changes or when it doesn't work. So chasing schedule is commonly done under the impression that NPV is enhanced. Implicit assumption is that any negative outcomes that result from shorter appraisal are outweighed by accelerated first oil date. In fact, when you talk to people about why they have to simply go 3 months or 4 months faster, they almost act as if that 4 months of production will never happen. But it actually will happen. It's 3 or 4 months later. Potential cost growth and schedule slip will have much smaller effect on NPV compared to gain from schedule. Disappointment in reserves and production attainment is rarely, if ever, considered. And I think that's the point we heard earlier about where we can't intervene in the wells we need to be choking back those estimates. If it's the first time we're doing something, if we're in deep water, if we can't visualize it, we need to choke back those estimates. Combined effect of cost, schedule, and production outcomes on NPV is more devastating than commonly believed, and that's what we're trying to show. Most Monte Carlo simulations are not going to pick this up. This is the real data with actual projects that were at these extremes that picks up this distribution of performance. So schedule itself is not the culprit for poor economic results. The practices are to blame. There are successful fast projects, but the schedule strategy was fit to where the data says you can go faster, and it wasn't the schedule that then said we're going to apply this to a project that is highly complex or highly difficult. Yeah? Schedule aggressiveness can lead to cascading events. We talked about the compression, we talked about the unclear trade-offs, the reserves, and we talked about the NPV erosion. So what are some of the consequences? You see here for some major metrics how they differ. Overlapped schedule-driven, sequential or phased in blue. And you see the production attainment is significantly lower for those with schedule-driven, about 85, 87% versus 76%. Wells cost growth, 5% versus 15%. Schedule slip, not much different. So the schedule-driven ones, they don't slip their schedule as much. But even the non-schedule-driven ones that are better defined also don't slip their schedules as much. But the time in front-end loading, which is here on the bottom left, is a big difference, right? They're industry average, and these are about half of what industry spends doing their definitional work. And then, of course, cost growth. So it always makes me wonder when people say we want to show that our company as an operator can do this in this new province, this new field, in this new environment, with this new technology. All the people in the world, all their eyes are on you because you're making a big noise about how you're going to show you can do this. So why would you set yourselves up where it's unlikely you're going to achieve what you're saying you're going to do? It would argue almost if this is strategic, you would want to invest more time and more effort if it's truly that strategic a project. But you're correct. We often hear the word strategic for that's a reason we don't have to follow our project process in our company because it's strategic. So how do some projects achieve faster schedules and still maintain value? They've completed their subsurface definition, they've defined their trade-offs, they've risked it more realistically, or they've done collected more data. So we set realistic cost and schedule targets based on the project definition. So the cost and schedule match the work you've done, not an expectation. And they're very stable. They have very few changes during execution. They do succeed. They meet their promises. So they're robust on their more conservative case. So what might we think? Speed is of the essence. I started out asking that. Well, some projects have delivered fast schedule with no loss of NPV. Fast schedule is a result of good definition and a plan to achieve that fast schedule. And faster time to first oil leads to an increase in NPV. So if you invest the time in the front end, you can achieve some of the faster execution schedules. If you don't invest the time in the front end, you're going to slip that execution schedule and still have significant cost growth. Chasing a fast project can lead to unintended consequences. Significant proportion of NPV is eroded when the targets are not met, especially the production targets. Poorly defined projects with aggressive schedules have highly predictable outcomes. So good practices lead to economic outcomes irrespective of whether or not a project is schedule-driven. Okay? The price for well-defined projects is competitive targets and preservation of expected NPV. Achieving best practical definition requires time and effort. Neither are made reliably available to schedule-driven projects by business. So when we cut short the front end, we have to expect that it will not be as well defined at sanction. And that means there are trade-offs. The most challenging aspect of delivering a successful project, a successful schedule-driven project, is not focusing on the schedule. It's actually focusing on the data required to define the project. It's possible to achieve a successful schedule-driven project with an aggressive target. There are well-defined projects with good integrated schedules and comprehensive execution plans that have succeeded. Without good or better FVL, a project is potentially giving up over half of its NPV that you think it has when you are sanctioning it. I think the final slide is, making good decisions is a complex optimization problem. There's a complex relationship between all of these drivers, the definition on the front end and the results on the back end. In fact, given how long the cycle times are of these projects, here's one of our problems, right? We have the people who are making these investment decisions early on are sometimes not even around anymore. They move to another role. When the project comes on stream, there's not much interest in digging up the past and understanding what went wrong. An economic simulator backed by strong data can relate drivers to outcomes, can reveal the effect of these true project decisions. What is this decision costing you? What is this decision costing you? Provides insight into the most appropriate balance between cost, schedule, production. It hopefully would give data to put preserving this number ahead of preserving this number, indicates the possible consequences of any decision. So true economic impact is not obvious and can lead to unintended consequences. It's not obvious. Most people accept the wisdom of the fast schedules, but the data and the business data show that has done more to destroy perceived capital value than any of the other decisions. Do we have any questions? I don't know how I'm doing for time.
Okay, time for a couple of questions before we take a break.
And I'll also be out there, you know, we've in the room if you have other follow-up questions.
Do you think it's a macho thing, actually, that project directors and business managers and company boards say, we are special and we can deliver this?
I think there's, you know, we hear about cowboys, and there is some of that attitude. When we look at a lot of the operators, they have well-defined processes for maturing reservoirs or for developing well programs or facility scope, but there's rarely a process on the business function side to make sure they're delivering what they need to deliver. So I think that the business desires flexibility. They don't realize flexibility is expensive, and if you want flexibility, you have to be prepared to pay for it. And I don't think anyone confronts them with the data of, I think most people are reasonable. They wouldn't want to do this.
Right.
But I think they don't realize that it's costly. But, you know, indirectly, sorry, you talked about share prices and lack of interest. I think the perception out there is that most of these projects are not delivered, and they're not.
Absolutely not.
And I think that should get people's attention as well, that they're...
Yeah. David, please.
Yeah, really enjoyed both talks. What I will say is I gave a very similar talk to this when I was working in Chevron, and I was given access to absolutely everything going back 40, 50 years, including little emails between the chairman. And by this time, they'd taken over Unical and whatever, and we built up this analysis of the projects. But it came down very much like it did today, that you got these projects in the budget, you didn't do enough geology, you didn't do this. But the one factor that is missing in terms of actually saying what is a good project is the very fact, for example, the company says we're going to get the first deep water development offshore Angola. Straight up front, everybody knows that. Well, they knew it in 2008 when I divulged the email, but across the company they didn't know it, but I was allowed to say that. And the company itself now is very aware that there is strategic. And people, even the young geologists down at the front, is made aware of that within that company now. But unless you actually strip those projects out, people looking at it don't know what a good project, don't know what a bad project is. And there are very few, as Mike says, that aren't strategic. But there are some that aren't strategic and stand out as very good projects. And those should be the ones we should concentrate on, unless we're going to start to discuss the wider world of why a chairman makes a decision with a president. Right. So I just wonder if you've got any data that you can actually put in there and say strategic, strip it all out, and then replot it.
I think we didn't cut it that way, but certainly we have the histories and the documentation to know from the objectives whether these were strategic or not. It could be interesting, but I don't know off the top of my head how those would. Intuitively, I would think there have to be some strategic projects that were well developed and many that were not. I don't know why they might not follow the same pattern. But this data set includes everything, so it includes strategic projects. But yeah, I don't know how, if those actually bias it toward the very negative side of things.
Okay, great.
Yeah, Greg Coleman with Petramol. How many projects go through the front-end loading and then don't go ahead? Because it seems like we have this tendency to always make them happen, sort of regardless of the consequence. I'm just wondering if you've looked at that.
On the percentages, so the data set here is all projects that went through it and then got completed. So you're right, there's a bigger set. I have a feeling once a project gets past concept selection, it doesn't get canceled. It just goes into FID. It may get delayed, but it will go forward. So from our perspective, the key gate for killing a project is at select gate. And, but it's very hard to make that decision when you have overlapped reservoir data and you don't know much and there's all this promise out there. Because, you know, we talked about people making decisions early and they're not around when the consequences are there. We have also incentives that are really not supporting each other. The exploration group wants to talk up their discovery, and the more you find out about it, the smaller it becomes. The more you find out about a project, the more expensive it becomes. And so unless these executives are, you know, they don't need to be extra smart in any way, but they need to apply the same criteria to every project that comes before them. Some kind of measure, this consistent measure of risk. Because if you don't, you encourage some kind of a liar's club in terms of I don't want my project to look bad, so I'm going to make it look as good as possible. And if I know less, it looks good. If I know more, it starts to look more expensive. So I think the most constructive thing the executives can do is just apply a consistent application of deliverables and risk measure. And that would be their function, is to be a very fair, consistent comparer of projects coming forward.
Okay, thank you, Roland.
Thank you. We've got